Hi, I'm Corey Litzenberger from CGLTax.ca, and this is Brainstorming Plus Tax. In this episode of Brainstorming Plus Tax, we're going to take a look at the new tax on split income rules and brainstorm the idea, what if we were unreasonable on purpose? Over the past year, a lot of emphasis has been placed on reasonable amounts of dividends. So where is this term reasonable defined in the Income Tax Act? The truth is it isn't, which makes it that much harder to comply or prove that you are being reasonable. In fact, the closest thing you can come to is in subsection 67(1) of the Income Tax Act that states, "In computing income, no deduction shall be made in respect of an outlay or expense, in respect of which any amount is otherwise deductible under this Act, except to the extent that the outlay or expense was reasonable in the circumstances." The translation is you can't deduct anything unless it is reasonable. So if it looks unreasonable, then you cannot deduct it. Now, this provision only disallows the deduction for tax purposes. It does not remove the fact that it still may be income to the recipient on the other side of the transaction. This is also known as a double tax provision. One person doesn't get the deduction, but the other person has to report the income. So what does this mean? It means that if I was going to pay a $100,000 wage to my spouse that is not active in my accounting firm, it is extremely likely that the Canada Revenue Agency would not allow this deduction in my corporation. And so I would not save in Alberta, $12,000 of small business corporate income tax, or if I was a large firm, possibly the $27,000 of high-rate income tax that the deduction would have given me. So it sounds like on the face of it that we should make sure to avoid these types of transactions that may be viewed as unreasonable. But let's brainstorm. If I'm a small business making less than $500,000 of profit in a year, and I want to pay my inactive spouse a dividend, in Alberta, under the new tax on split income rules, she is going to pay roughly 41.6% taxes. So every dollar that I allocate to her is going to be 41.6 cents of tax. Now, if she's already in the highest tax bracket, then there's no issue because it is the same rate either way. But in fact, the real impact on these rules are for those that are not in the highest tax brackets. So what happens if instead of giving her a $100,000 dividend, I decide to pay her an unreasonable salary of $100,000 instead? Now, before we go any further, you must keep in mind that there may be other payroll taxes and CPP to consider in these calculations, which could change your results. But you will see that at lower amounts, this becomes less of a concern and more of a plan. So in Alberta, assuming that my spouse has no other income, that $100,000 dividend for tax on split income would cost about $41,600 in taxes. However, if I paid her a wage and she's able to use her personal tax credits and her graduated rates for the different tax brackets, that $100,000 would only attract $24,600 in taxes. So what would I lose? Well, assuming that the $100,000 is not deductible because it's unreasonable, and I am a small business, I would not get the deduction and lose the $12,000 in tax savings that the deduction could have given me. But do I care? Keep in mind, even by losing that deduction, dividends are not deductible either. So the tax inside the corporation is the same whether I pay her a dividend or an unreasonable wage. The real difference then becomes the tax on split income dividend rate versus the tax on wages. In this Alberta small business example, the difference ends up being $17,000 before we even factor in CPP or payroll requirements. Now, I've done the math for every province, and it appears to work for almost every situation where the active spouse is already in a high tax bracket situation. Now, the amounts will change as you have a higher wage or a lower wage, depending on the benefit that you're trying to achieve. Now, the CPP, obviously, we have to consider on whether it'll impact based on the wages. Now, if I look at a different amount, so instead of the $100,000, because I'm a small business, let's just say I can only afford to do $40,000. Now, some of you may be saying a $40,000 wage does not sound unreasonable for a spouse. However, if you met my wife, she has no desire to do anything involved in my corporation. So what if I paid her that $40,000, assuming that, again, that she has no other income from any other source? Well, again, I don't get that deduction, and so I'm losing some possibility of sheltering some tax, but if I was to give her a dividend, she's going to pay well over $16,000 in taxes. But if I gave her a wage for $40,000 and the CRA said it should have been zero, well, that wage would only attract $6,000 in tax. So the difference is roughly a $10,000 differential, not factoring in the CPP. Being the income is lower, the CPP itself for both sides, the employer and employee, would still only be about $4,000. So we're still ahead by about $6,000 by paying an unreasonable salary of $40,000 to my spouse, who's not active in the business, in Alberta. Sounds like a lot of money to be saving on $40,000. Now, really what we have to look at is the balance between having the active taxpayer receive a dividend based on their tax brackets versus the inactive taxpayer receiving an unreasonable salary as well as any related payroll costs. Now, will the CRA or finance look for other ways to close this possibility of planning down? Will they try to argue that there is somehow a shareholder benefit under Section 15 by having something not deductible to a corporation? Or what about our friend under 245, the general anti-avoidance rule? Now, while I personally think those are a bit of a stretch, it definitely seems to be something to think about in your planning to be unreasonable. Especially since once CRA and finance hear this podcast, they're probably not going to like me too much. And with that, for CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger. Thanks for listening.